YouTube, what it do? It is your boy Young Soros here, back in another video, and today we're gonna be going over why higher bond yields, aka interest rates, having them higher is bad for the stock market as well as bad for economies. Now, let's jump right into it. If you guys enjoyed the video, make sure you drop a like down below, comment and subscribe what you want to see next. So, with these interest rates and these high yields, the reason they are going so high ever since the start of 2022 is because we have to fight inflation. Inflation is caused when basically your money starts to lose value. So, when your money starts to lose value, you sit there and go, how can we combat this? You got to take money out the system. You got to take money out of people's hands. And one way this is done is with interest rates, which is what the Fed is doing right now. Now, the thing with interest rates is you want interest rates high so that way money can be hard to get. If money is hard to get, that takes money out of the financial and economic system, that allows money to stop being circulated as much, therefore lower inflation, because all inflation is just there is more of the currency. So if everybody has $10, then that $10 is eventually going to become $1, right? You know, if everybody has a $10 bill, that $10 bill is just going to become a $1 bill, right? But if everybody has a $1 bill, and that $1 bill is going to become, less than a dollar in terms of monetary value. Now, let me try to break this down, right? Let's say you got $100. If everybody has $100, it's basically going to be worth $1. But if you're the only person in the world with $100, that $100 is going to be worth a lot more versus if everybody had it. You know what I mean? I hope you feeling me on this one. So, what does this have to do with higher bond yields and all this sort of stuff, and why that's bad for the economy? Because higher bond yields going up increases credit risk. What is credit risk? Credit risk is basically, a chance of you defaulting on your debt obligations. And why is that so bad? Because if I lend you money and you can't pay me back, who is going to pay me? You feel me? Who is going to pay me back? And then once you can't pay me back, then that means you lose and I lose and everybody just loses, right? And once you start defaulting on debt, that's where other things start to happen. Your social security programs start getting delayed. The financial markets start taking a hit, aka the stock market, the bond market, money markets, all these types of financial markets, they all start to get rattled, because if you can't pay off your debt, then how am I going to be able to afford the things that I can if I lent you my money? So it is just one of those things, right? And if you can't pay off the debt that I gave to you, if you can't pay off your dues, then I'm going to go bankrupt, because I can't afford to pay off the next guy and the next guy and the next guy. And then that, snowballs into, now we're in a recession, or we could get into a credit crunch. Now, with a credit crunch, basically what happens is, right, you have all these different defaults going on, and once the credit crunch happens, it is going to be extremely hard to borrow money from banks. It's going to be extremely hard for, it's going to be extremely risky for banks to loan out loans. It's going to be hard to get loans. Nobody wants to loan anything out, and once that happens, the economy slows down even further. Now, I hope you're picking up what I'm putting down. This is the reason why you have to have these higher interest rates to fight inflation. It may be bad for an economical sense, but inflation is worse. You don't want inflation. You would rather have a slowing, stagnant economy than high inflation. Now, is there times where you want to have inflation? Yes, most definitely, but you don't want inflation to get out of control. Now, with that being said, if let's say you're in the recession right now, we're in the recession. If you continue to have these defaults and you continue to have these different things going on, you start getting into the realm of there is going to be a loss of liquidity in these different financial markets. And once that starts happening, you are in for a world of pain, and it's going to be extremely hard to even get money in and out of different places because you need liquidity in order to get your money in and out of these different financial markets, move your money from a bank, or you want to buy some real estate, get a loan, do any of this stuff, right? It is going to be extremely hard to do that if there is not enough liquidity in the system, right? So now you may be thinking to yourself, okay, high interest rates sound bad. This is all, it's all bad. Well, not necessarily, right? You don't want rates at zero forever because, as you can see, inflation can occur. So there is a middle ground where you want to reach where, if rates are too high, then that's where you can hit the default issues and the credit crunches and the recessions, right? But if rates are too low, you can easily go into a inflation, hyperinflation, stagflation type scenarios, which is what you want to avoid. So there is a middle ground that the Fed is trying to reach currently, and you just got to trust that they can reach that and they don't break anything in the process. Now, I'm going to fill you in on a little secret, guys. The Fed wants to cause a recession. Now, they don't want to cause anything too severe that will create a depression or, collapse anything, right? But that is what they have to do. They have to cause a recession, but they don't want to cause a depression. Now, what's interesting about the scenario that we're in currently is that they have to cause a recession, but they can't bail us out like they did in 2020 and 2008, because if they do that, then the recession will turn into a depression. Before, the Fed could afford to, in 2008, they could afford to be like, okay, we're on the brink of a depression. Let's, save the markets. Let's bail out some people, right? They can't do that this time. They already put too much money into the system. They already bailed everybody out. So, them going through this economic downturn only to bail people out again is not only foolish, but if they do that, the outcome is going to be way worse than if we just go through the pain and continue with what we're already doing. Now, I got some good news for you guys, right? It isn't all bad. Interest rates going up isn't all bad for everybody, right? You can still benefit off of high interest rates. And one key, I guess you could say, one good thing about high interest rates is that bond yields, you can get a pretty good return on bond yields, 4.7% on your money, right? That's pretty good, especially if it's just sitting there doing nothing. You don't have to touch it. And that's the thing with bonds, is that with high interest rates, they go up in value. If you buy them at like 5%, that's a pretty decent return. It may seem small into, a guy, it may seem small right now, right? But 5% can add up to a lot, especially if you, linked out with other different asset classes and, how you want to go about it. It's all about what can you do for me? It's all about, if you put your money somewhere and you park it, are you going to get a good return? Are you going to gain on your money instead of losing it? Because if you just hold cash, right? If you just hold cash during, this inflationary period, then you're going to lose money. You're going to lose value. So you got to keep that in mind. It isn't all about, the 100% gainers and, 1,000 percenters and things like that. You may be thinking to yourself, oh, but why would I buy a bond when, AMD is like 4% and that's almost the same percentage as a bond, right? That's where volatility comes in. That's where knowing risk and reward. AMD may move 4% in a day. You may get more for that than you could with a bond. Yes, but If you park your money in a bond, you're guaranteed 4% versus AMD. You may lose everything you put into it. You just never know. And if the government somehow, defaults on these bonds and somehow you can't get paid on these bonds, then that is the day where we're just gonna be screwed. That is a day where you don't want to see that day. That day isn't today though. So what I'm saying is, as a smart investor, if you want to survive this economic downturn with as little risk as possible, park your money in bonds. This is a perfect time to buy bonds. The bonds were, they were on a decent run. But now it is time to go back to the old ways. Buy bonds, buy some dividends, or maybe not even buy dividends, because now the dividends are competing with the bonds. So maybe you want to diversify. Maybe you want to see the different types of bonds you can get. If you need the money now, go with a shorter term bond. If you don't need it now, park your money in a longer term bond. It is really up to you. Now, another sector that benefits really well from high interest rates. Now this is going to be a little controversial, but bank stocks. Now, I know what you're thinking, right? This looks pretty volatile. This is the chart it looks pretty bad, right? The chart looks pretty bad, extremely volatile, and bank collapses and all that sort of stuff. It is a double-edged sword with the banks, right? It is a double-edged sword. Here's why. Higher interest rates for banks means they can charge higher interest rates for the loans they put out, meaning they can get more for the same loan they could put out if rates were at zero, right? So if I lend out 10 loans at 0% interest, I'm not gaining nothing versus I lend out 10 loans at 5% interest rate. But here's the caveat to that. Now, since you have higher interest rates, it's going to be harder to not only get those loans, but also harder for people to pay off those loans and afford those loans, meaning there are going to be less people buying these loans. So it is a double-edged sword when it comes to the high interest rates. It is really it is a delicate balance. If you can get that delicate balance with the bank stocks, it doesn't matter if rates are going as high as 10% or as low as 1%. It does not matter. Why? Because banks benefit off of interest. If you park your money, right, if rates are at zero, for example, right, rates can be at zero. They may not be making money from the bonds or the loans at zero, but they have liquidity because people are parking their money in these bank accounts, right? So people are parking their money in these bank accounts. They have liquidity, so they can, now the banks can actually take, the cash. They can go buy different properties, buy different assets. And once that happens, it expands, the value and builds their portfolios and all that sort of stuff, right? Versus in a high interest rate, scenario, they have less liquidity because people are taking their money out of banks. People are afraid, so they don't have as much liquidity. They don't have as much flexibility. But now they're gaining off of the interest rate because they can charge higher interest rates on these bonds or on these loans, right? So, with that being said, banks are really good. The banking sector is a really good place to invest in during economic downturns. It may not seem like it because banks are the main focus when it comes to economic downturns. How will they hold up? How well will they hold up? All this other sort of stuff, right? It may not seem like banks will do that good. It may, things may be a little shaky, but I promise you, it is a double-edged sword. They can make money both ways. It is just all about what is going on in the economy at that time. It's not as specific as interest rates are 5%, banks make money, or interest rates are zero, banks lose money or make money, or whatever. There are certain things that are unique to the banks that no other sector has that makes them benefit from either way. Now, with that being said, there are some downsides to this, right? Bank stocks, if let's say rates go all the way up to 5 and they bought bonds when they were at 0, they lose money on those bonds. Yes, they lose money on those bonds because now the bonds are 5%, but you bought the bonds when they were at 0, so you paid more for those bonds. Now what's going to happen is that you're going to have to say to yourself, am I going to sell these bonds, or am I going to hold them to maturity and get the 0% interest rate, or am I going to take the loss now, buy the higher bond yields so that way I can make a profit? It's really just about how you go about it, and that's why bank stocks dropped so low in 2020, because everybody was afraid what was going to happen when your Fed cut rates to basically 0, the credit crunch, all that stuff was happening in 2020. And then as rates went up, even during 2022 when they announced rates, even though banks sold off a little bit, even though they announced rates, it wasn't as bad until you had the banking, crisis, right? It wasn't as bad until you had the banking crisis, and even now, the bank stocks are selling off a little bit because of higher rates, but that is because of what's going on within the financial world itself, not necessarily because of the high interest rates. Banks can rise during periods of high interest rates and periods of recessions, but it is harder to loan money and to get people to pay off these loans at a higher rate, but they can make a good amount with these higher rates. Okay, now the next sector we're going to be talking about is insurers. And now I'm not going to get too much into this. Insurers are basically the same thing as the banking sector. The only difference is you're not parking your money with them. They're more so giving out loans, giving out all these different things, right? So banks and insurers, we're going to lump them into the same category. Now, if you really, really want to be ahead of the game, right? If you really want to be ahead of the game and ahead of the curve during this economic downturn, then you want to be looking at healthcare. Now, healthcare and biotechs more specifically, these stocks, especially during economic downturns or even bear markets for that matter, they tend to outperform. And what's good about these stocks is that they're usually stocks with high dividends, high paying, good companies, all that sort of stuff. They have really, really good value built into them, and it doesn't matter if it's a bull market, bear market, high rates, low rates. I mean, the chart speaks for itself, right? Even though you had all this market volatility and all these sort of things, most markets sold off. Like if we take a look at KRE, for example, which is the technology sector, if we take a look at the okay. If we take a look at the technology sector, this is a lot of volatility. And if we zoom it out, take a look at the 10-year chart, look how volatile it is. It almost looks exactly like the S&P 500, extremely volatile. So versus biotechs, it has been relatively in the same spot. Even through all this market volatility, even through all the, rates and, everything like that, it has been relatively stable for the most part. So what does that mean for you? It means that, this can offer you a pretty good reward, but look at the risk. Look at how volatile it is versus, XOV during bull markets, bear markets, it doesn't matter. Even when we had the banking crisis right here, October lows, it never dropped below 120. It never dropped below 120. And it's very interesting because as we approach a new age of, the economic cycle, you are going to want to park your money in sectors like this: healthcare, utilities, banks, all this other sort of stuff, right? So it is very interesting to see how the market will develop over the next couple of years, because this technology sector, extremely volatile, high risk, but it is one of those things where you gotta say to yourself, all right, what do I want more, right? And it's good to play it safe sometimes, especially in the financial markets, because it's not all about chasing the huge gains. It's about the small wins that can compound into big wins, and then next thing you know, you're off to the races. So that way, those small wins can compound into one day you change your life. So you can't look at it like, oh, these are just small wins, and look at what you can do here, here, here. It's okay to speculate. It's okay to, go for the big play. But what I'm saying is, if you want to build long-term wealth, then you gotta follow these principles. Okay, you gotta understand how the economic cycle works. You gotta understand interest rates. You gotta understand how the bond market works. You gotta understand how the stock market moves, volatility, and all these sort of things. So one day you can be successful, and you don't have to worry about another 2008, another 1929, and the next recession, which is right around the corner. It's going to be a depression, but you don't have to worry about that, because you will be knowledgeable enough to navigate these tough times. And remember, I've said this in previous videos before, depressions create generational wealth, recessions create wealthy people. You can get rich in a bull market, but it's wealth that is made during bear markets. All right, guys, so you got to keep that in mind. I hope you guys enjoyed this video. It is, drop a like down below, comment and subscribe, share this video. I want to get this knowledge out to people. This is important. People need to know about this sort of stuff. I'm not doing it for me or anybody else. I just like talking about this stuff, and I want to give out the knowledge I have to offer. I want to see everybody eat. There's no point in me having all this knowledge if I can't share it.